Hi, I'm Aarti Krishna and you're watching A to Z of stock market investing. Today we are doing the last module, Z. As a school goer, have you ever resented the system where students are classified into different sections based on their academic record? The stock markets also have a similar class system in place today. This is where the Z group of securities comes in. The BSE, India's oldest stock exchange, classifies stocks into four different groups: A group, B group, T group and Z group. A and B group stocks are the most traded and most popular stocks on the exchange. Stocks with a high free float, high liquidity, which are well governed and are compliant with all the exchange rules are put into one of these two groups. The top 300 stocks which meet these criteria fall into A group and the rest fall into B group. The T group is reserved for stocks which the exchanges suspect are the object of speculative activity. So if they want to put a certain company stock under surveillance, they shift it to the T group and then watch over it with a hawk eye. The Z group is reserved for stocks of companies which misbehave on the exchanges. Therefore, these are the companies which do not comply with any of the listing agreement rules specified by the exchanges. The company may not be filing its statutory requirements on time. It may not be actually resolving its investor complaints which are piling up with it, or the company may not even have complied with basic rules like dematting its securities. When a company falls foul on any of these counts, the stock exchanges classify it into the Z group. Usually, when any company seeks to raise public money and list itself on the exchanges, it has to follow something called a listing agreement. This is an agreement that every company signs with the stock exchange. The listing agreement requires every company to comply with certain basic requirements. First thing is the company has to file its quarterly results within 45 days of the end of every quarter. Similarly, before 21 days of the end of every quarter, it has to file a shareholding pattern. Whenever there is any price sensitive information happening within the company, it has to notify the stock exchanges immediately under the material disclosure norms. Now, if a company does not follow any of these rules and fails to notify the stock exchanges on time, that is when it falls foul of the listing agreement rules. When this happens, usually the stock exchanges will wait for 2 quarters, and if a company is repeatedly defaulting on these requirements, it moves them into the Z group. Today, the BSE alone has this classification of A, B, T and Z. The NSE actually moves stocks to something it calls the trade for trade segment. If you're a student of financial markets, you must have heard of this term called vanishing companies. This term is often used by regulators such as SEBI and the Ministry of Corporate Affairs. Basically, in the 90s, there were a large number of Indian companies which tapped the markets and raised public money through IPOs. But 2 or 3 years later, they simply vanished with all the money and investors were left in the lurch. It is to avoid a repeat of this experience that both SEBI and the stock exchanges have put tighter compliance norms in place for companies that list on them. Usually, when a company plans to slip into obscurity, the first thing it will do is stop filing its statutory requirements like quarterly results or shareholding patterns. Therefore, shifting a company into the Z group acts as an early warning system for investors who may want to buy it in the secondary market. While it will remain categorized as Z category, apart from that, the basic settlement system in that stock undergoes a change. You actually net out the buy and sell orders and only pay the difference. When a stock is put into the Z group, it is actually subject to trade for trade settlement. So in the TFT segment, an investor who wants to buy a stock actually has to cough up the entire cash that is required to fulfill his order. Similarly, an investor wanting to sell the stock also has to have the entire stock with him for offering delivery to the buyer. The idea behind this is that these Z group stocks being very dodgy from a governance perspective, you mustn't allow traders or investors to build up very large speculative positions in them. This is why every time you try to punch in a buy order into your trading terminal to buy a Z Group stock, you will get a pop-up warning from the stock exchange saying this stock belongs to the Z Group. Do you want to go ahead? If you say yes, then you must be prepared to face the consequences. So with Z for Z Group, we conclude our series of videos on A to Z of stock market investing. This was great fun to do, and I hope you people enjoyed watching it as much as we enjoyed making it. Do let us know if you would like to see videos on other subjects that relate to the capital markets, to the economy or other areas of business. We'd be glad to oblige.